You're listening to the Good Food CFO podcast, where we focus on financial strategies for building a profitable food business. I'm your host, Sarah Delavan. Today on the podcast, we're talking about Amazon and Shopify financials, specifically the steps that you should be taking each month to ensure that you're gathering and recording all the necessary financial information to evaluate the profitability of each platform. Now, if you work with a bookkeeper and don't manage your own books, take note, or better yet, forward this episode to your bookkeeper, because 9 out of 10 bookkeepers that I work with through my clients were unclear on how to gather these details and record them in Quickbooks. As the business owner, you need this info to make fully informed decisions. So let's get to it. All right, guys. In a recent episode, I spoke with Alexander Johnson about the costs associated with selling on Amazon, and we also talked about his formula for profitability. But how do you know if it's working? How do you know if Amazon is a profitable sales channel? And how do you know if your Shopify site is profitable? Almost every food and beverage business that I work with sells online, right? Either through their own Shopify site or via Amazon or both. And as I mentioned in the intro, 9 out of 10 bookkeepers and all of the business owners who keep their own books were not gathering and recording the full monthly financial data from these and other online selling sites. They were all 100% across the board recording online income based on the amount of money deposited into their checking accounts. And if I were a betting woman, I would bet that most of you listening today do the same thing. Now, as your Good Food CFO, I want to help you understand why this is not the best way to track your online income. And of course, I'm going to share my recommendations for recording Amazon and Shopify income in a way that allows you to see the profitability of each sales channel and make informed decisions. So let's get started by talking about 5 reasons why recording income based on deposits is not the best method. Number 1, these sites deposit funds into your bank account after their fees have been removed. So if you're simply recording the revenue as the amount deposited into your checking account, you've got inaccurate revenue numbers. The number is going to be lower than the actual value of the sales that you made, right? And as a result of that, your COGS percentage calculations are also going to be inaccurate. They're going to look higher than they really are. Reason number 2, if you're recording revenue this way, you're also not recording things like seller's fees, merchant fees, flat monthly site or membership fees, shipping costs, etc. All of these things are important for you to be aware of, and they are the very things that help to illustrate the profitability of the sales channel. Reason number 3, when you record your revenue based on deposits, you're actually recording partial monthly revenue, not full monthly revenue. So both of these sites deposit funds into your bank account based on their own independent schedules, not based on calendar month. So you're not getting one nice clean deposit, let's say for all the sales that you made in June. What's actually happening is the deposits that are hitting your bank account in June are going to include some of the sales you made at the end of May, and they're going to go until, some of the last few sales that you made in June. But any of the sales you made at the very end of June probably won't actually get paid out until July. So you don't have a clear picture of how much you actually sold in a single month. There's a little bit of a blend from month to month. Reason number 4. There's also an accounts receivable implication here. So let's say, for example, that you sold $5,000 worth of product in June. They deposited your sales minus their fees into your account a few times throughout the month. And they might still owe you $500 for sales you made in June. That's an accounts receivable, right? It's a sale that you've already made and have not yet received payment on. Now, this accounts receivable value is important to track for two reasons. Number one, so that you can confirm that all of your payments have been received, right? You want to make sure that Amazon and Shopify have paid you for all the sales you made on their site. And number two, doing so will allow you to see that sale as part of your June P&L, right? And as part of your June statement of cash flows. Reason number 5, when you're projecting future sales or sales by channel, we often look back at historical data as a starting point or to see how we performed, right, last year or over the last few years. And if you're recording sales based on deposit date rather than on sale date, you're going to be looking at some skewed sales numbers, right? You're not going to get a clear picture of the number of units moved and even the number of units sold in a particular time frame. And I want to say that I completely understand why people record Amazon and Shopify financials this way. It's easy, right? It doesn't take any additional work, but as I discussed, it also doesn't provide any real value to you as a business owner, and it actually skews your financial data. So what is the ideal situation? What is the ideal method to utilize on a monthly basis? Ideally, you or your bookkeeper will pull detailed reports from Amazon and Shopify each month that show revenue, any service fees, merchant fees, shipping fees, etc., so that you have a full financial picture for the online sites that you sell through. Amazon actually does a really good job of making this easy. They have one clear monthly summary report that you can pull that makes gathering and recording this information very, very clear. Shopify, on the other hand, it makes you work for it a little bit. You've got to run a few different reports to gather these numbers. The reports are, I'm pointing, they're kind of located in different areas of the website. And it's not that it's difficult, it just requires clarity on where you need to go and where to look to gather these different pieces of information. And after you've done it a few times or kind of recorded the process, it really is very simple. So once you've pulled these reports, what you want to do is create what's called a journal entry in your accounting software, and you're going to record the income and all of the fees incurred for that sales channel for the month. This is the step that allows you to get accurate monthly revenue and expenses by channel. And that in turn allows you to see profitability by channel. Now, don't get scared by the term journal entry. I know it sounds like maybe a scary accounting term. It's actually a very easy process and one that you can either find online or find in the online program for how to do it. If you're working with a bookkeeper, they are well versed in how to do journal entries, so they shouldn't have a problem with the process at all. Now, before you begin making your journal entry, you need to make sure that your chart of accounts has a few very specific accounts created in it. So we're going to start with income accounts for each sales channel. So in the case of what we're talking about today, you want to have an Amazon income account and you want to have a Shopify income account, right? This is going to allow you to see very clearly how much you are earning in revenue from each channel. You also want to include a cost of goods sold and expense account for any of the expenses that you are incurring from each of these channels. And you want to include Amazon or Shopify in the name. So getting detailed here at this point in the COGS and expense account names is going to allow you to see the profitability per sales channel. This is where we're setting ourselves up for success. We're setting ourselves up to be able to see the revenue and the expense data very, very clearly. And last but not least, you want to have an Amazon receivables account and a Shopify receivables account. Now, both of these accounts are going to be considered bank accounts. Okay? Once you've got your chart of accounts set up, you're going to go back to the journal entry, and this is where you're going to record your sales. Let's just say we're working with Shopify information. You're going to record Shopify income or Shopify sales, and you're going to put your total revenue number there. And then you're going to get to work recording any of the Shopify expenses that you incurred for the month. And QuickBooks does a really good job of keeping a tally of the sales minus the expenses, and it's going to eventually pop a balance into that journal entry for you. This is the amount of revenue left over that's actually going to be deposited into your bank account, okay? And you're going to record it as Shopify receivables. This shows the exact amount of money that Shopify owes you for the current month's sales. Now, when Shopify deposits funds into your bank, the receivables amount decreases. And this is how you can confirm that all of your payments have been received, and you can get accurate reports of accounts receivable at any given time, right? So it's unlikely that the Shopify receivables account will ever hit $0 unless there's a span of time that you have no sales on Shopify, or maybe there's kind of a point mid-month where you haven't recorded your the next month's sales yet. And so that account might hit zero, but there's always going to be, a little bit of a balance there, and you can always track your accounts receivable. The benefits of taking a bit of extra time to record the details of your Amazon and your Shopify sales allows you to see your revenue by sales channel, your seller and service fees by channel. It allows you to see if your shipping offer is costing you money, or if it's, you're hitting break even with it, or even if it's profitable. And it allows you to see the overall profitability of the sales channel. Knowing the profitability of each channel that you sell through will help you to determine if your pricing needs to change in a particular channel, if your shipping offer needs to change, or if it's a channel that should be focused on for profitable growth. Or maybe you need to abandon a channel to avoid losses, or continue with a not so profitable channel that helps you build brand awareness and grow your audience. The list goes on and on in terms of the value that having this information provides. But the point is that with this information, you can make informed decisions. At the end of June, I'm going to be releasing an online workshop that walks you through this process step by step, as well as how to accurately record transactions for Shopify Capital, which has become a really popular funding option for small food businesses. In addition to the webinar, there's also going to be a live Q&A session. So check the show notes or visit sarahdelavan.com for the dates and details on how to sign up. As always, these workshops are totally free for clients and members of the online program. So if you're a client or a member, all the info that you need is available in the client community. I want to thank you for hanging out with me today, because having good data is important for you to be able to make fully informed decisions, and I am happy to help you to do this in any way that I can. If you've enjoyed this episode, please comment, rate, and review it. That's the number one way that you can help other food and beverage business owners find this show. If you happen to be watching on YouTube, go ahead and subscribe, and you'll get updates whenever new episodes are released. I'll be back in 2 weeks with another new episode. Until then, have a great day.